Perfect. Welcome, everybody. We're going to give you a minute we can see the number of participants rising. So we'll give you a minute to get situated and then we will get started. Perfect. Here we go. Everyone's strolling on in. Great. I'm going to start with introductions. I'm J.Thelander, founder and CEO of J.Thelander Consulting. We've been in this business now for almost 3 decades and covering the private capital markets on all aspects of compensation with both data and consulting. So the private capital markets include private companies and investment firms, both venture, private equity, as well as corporate venture. And I'm going to turn it over to James Fisher, who is my esteemed colleague and been great to work with at DLA. And Jim, I'm going to let you describe what you're up to and why you're on this panel today.
Sounds good, Jody. Thanks very much, and pleasure to be with you all again today. My name is Jim Fisher. I am a partner at DLA Piper in our corporate practice and the vice chair of our corporate venture capital practice. DLA is a global law firm. We represent large multinationals in the corporate space as well as the venture space, both traditional and the CVC space. And we're always happy to be a part of these conversations and look forward to a nice discussion.
All right. Yeah, we'll turn it over to you.
And I'm Tamara Steffens. I'm the managing director at Thomson Reuters Venture Fund. We're a venture fund based in New York City, but our company is based in Toronto. We luckily use DLA as our outside counsel, so that's how I got to know both James and the J.Thelander Group. So excited to be here and answer questions where we can.
Great. That's actually a good way to segue. We would love this to be interactive. You know, I've always got an arsenal of slides and data and information, but it's a relatively small group today, an intimate group. So there's lots of flexibility to navigate the conversation around what your priorities are. So we've got Morgan on my team monitoring the chat. So please feel free to jump in and we can segue around what the priorities are and also take a minute to, sometimes I feel like we cover too much information and don't go as in depth. So given the fact that we have a nice sized group today, we can slow down a little bit and cover some topics in more detail. So with that, I'm going to share my screen and we will send a recording of this out afterwards in case there's something on here that you maybe missed. And also feel free, if something's of interest, to take a picture. We just ask that you don't post anything online. So with that, we are moving into a little bit of who J.Thelander is. So as I said, we've been doing this for almost 30 years, and we only have one lane on compensation, and everything is covering the private capital market. So no public companies, no public data. So it's always the mix for the portfolio companies on cash and equity, and for the investment firms on all the topics around cash and carried interest. And we've had the good fortune to be in all these esteemed publications and media organizations as of lately in the past couple of years. So we're really excited about that. Just in Fortune magazine 2 weeks ago, and the Wall Street Journal as well. So that's sort of fun. And that never gets old. And the areas that we pulled the data from, the other thing that's nice about J.Thelander right now is that everything is real time. So the data that we pulled just came out this week, and all of our surveys are open year round versus back in the day when we used to publish things on a 6-month or an annual basis. And a little bit by the time you got it, one could argue that it was stale, even though it was published pretty quickly. But we run on the investment firm side a comp survey, salary increase and bonus questions. And then we have a separate set of questions for those of you on the corporate venture side, because as you can imagine, your compensation is a little bit different. So that includes all the comp questions, salary increase and bonus, corporate stock and carried interest, as well as an overview report. And everything is published in aggregate with no individual name shared. So by way of background, this is a little bit of the landscape on both the investment firm and CVC. And you can see that CVC is a pretty healthy part of this, 18% of the data. And then Jim, maybe you want to weigh in here. You know, we look at venture data by assets under management, like there's no question, right? Even if it's venture or private equity, because private equity typically starts with a higher AUM. And we also see now with CVCs that it can and cannot matter. It really is just very, it's random for what jobs maybe the assets under management do impact. What's your take on that?
Yeah, I mean, I think to your point, a lot of it comes down to how is the firm structured, right? What exactly was the sort of thesis at formation in terms of what types of investments were being made, how you were going to value those investments, how you were going to carry them on your books? Is it more of a investment by investment sort of thesis, or is it more of a fund sort of concept or thesis? And so I think a lot of it has to do with kind of how the fund was structured, and if it's a fund at all, or if it's more of a commercial type investment where you're looking at making investments in things that you believe will be beneficial to the overall public company's thesis and strategies going forward, and then how does that grow or not grow? Hopefully, grow, obviously. So I think again, I would just say it comes back a lot in my case to what we see to the foundations of the institution and the firm in the first place.
Bro, do you have a thought on that about how things are structured? Like, in terms of what you've obviously had a long ride in the corporate venture world in terms of things being structured. What's your experience?
It varies, right? I've been with a couple firms now. So it really depends on what I think the corporate fund, the direction and where they're going. I think if they're a financially focused fund, so both in my case, Microsoft and Thomson Reuters, the goal of the fund is to return the fund. Now, we only invest in things we know. So we invest in the strategy that is set by the company because that's where we can do our diligence and we have the most experts. But I think if it's set up to be a financially focused fund, the terms and the compensation will be different. In my case, I believe it will be better if it's a financially focused fund than if you're really just doing strategy work, investing in things that are strategic to the company and the return isn't as important.
Yeah, we see. We just have this. Yeah, go ahead.
I was just going to say, Tamara, I think it would be harder to judge too, right? If it's not sort of financially focused, that you'd kind of be looking at things that aren't as objective, perhaps, as financial return. And so that sometimes we see captured in terms of how people are evaluated for purposes of their compensation if it's not financially focused or as financially focused.
Correct. I agree.
Yeah, I'm going to switch to this in a second. We had this with a client yesterday saying, as they're looking to put in place a shadow phantom or some kind of carry, it's obviously challenging to do that if there is no financial focus of the firm, right? Because how are you going to look at the shadow phantom? Like, what is it going to be based on? I'm going to go back to just a little bit of background for a second as we move into this, because this gets into, here are the list of positions of the firm positions. And you can see all of this is in the full survey, right? All the investment professionals and so on. And then here are the list of CVC positions. And these new jobs, or some of these jobs that have really rolled out, because when we started the first survey, we only had like 6 jobs, right? The CVC unit leader, and then we had the senior investment professional. Now we've had so much data that we've had to move that into 2 levels, senior investment professional 1 and then 2. And then in addition to that, all these other roles around portfolio development, the CBBD roles, which are now not only the executive level 1, but then the next level down, in addition to the senior associate, and analyst. And on the venture side, there's been a little bit of taking a page out of this playbook, because they are using some of these roles, this end-to-end solution that CVCs have provided to the portfolio companies, as a little bit of a model. I mean, Tamara, you're seeing that as well, right?
Yeah, we are. Absolutely. So we kind of use the same model as a traditional firm does, because that's the way we want to be set up, right? So that we have financial returns as the focus.
Yeah. All right. I'm going to move into one other piece by way of background with this, is that we publish a CVC digest. We publish a private company digest, an investment firm digest, and a CVC digest. And really, this conversation today is really predicated on the fact that, of course, we pride ourselves on having great data, but the data is only as good as your expertise and formality around the knowledge of what you want to do in your CVC unit. And that's what these digest really does. So like there's a one that we did on the goal of your CVC unit impacts compensation, which is really what we're talking about today. So I'm going to move into that. Exactly this. Maybe Jim, you can go ahead and describe sort of what the different structures of the investment firm could be, of the investment fund for a corporate venture.
Sure. So there's obviously multiple different types of funds that can be set up. And I'll tell you, we're seeing even people become much more creative than we're about to talk about here. So there's definitely a process pursuant to which people are trying to create new ways to incentivize professionals. But on the far left hand side, you have individual venture investments or projects on a case by case basis. Well, what we really mean, frankly, is there's no real fund that's formed there. It's really more of a one-off investment structure. A lot of times it'll be situations where you have a large corporate that one of its sort of either divisions or subsidiaries will quote, sponsor a deal or back a deal, and you're looking at making individual investments in individual projects. We see that all the time. Some funds have been set up like that for quite some time, and there's lots of new ones that come online to sort of deal with that issue. Sometimes in this particular case, you have perhaps a president of a division who really believes in venture and wants to sort of use it as a tool to grow his sort of part of the public company, and others perhaps that don't. And so you see that sometimes used in a way to kind of not have to commit particular amounts of dollars to a fund, but still allow sort of strategy and innovation to be part of the conversation for the parent company. The next
Right.
two, yeah, sorry, go ahead, Jay.
Yeah, I mean, and that is a little trickier because you probably don't have as much of a dedicated team.
Correct. In most cases, you have individuals who maybe have some background in venture, but that's not their primary job. Their primary job is to run their division or their business, and they're looking at this as sort of a way to enhance that, for lack of a better term.
Right. And then the one with the balance sheets or the off balance sheets or no off balance sheet or a separate entity, but a dedicated team, that obviously is more independence and can typically impact the compensation as well, or the philosophy.
Correct. I mean, the next two for sure are the ones where you might not have a separate legal entity, but you have sort of I would say the parent company is fully invested in sort of the concepts of how you're going to go about making investments, and it's intended to drive, whether it's core to what the parent does or sometimes outside of the core of what the parent does. You certainly have sort of dedicated programs, and it's just a question as to where the capital is placed, how it's placed, and what sort of accounting and tax functions you're using to sort of mark to market your transactions and things of that
Right.
nature.
So tax considerations, and that's where the legalese really comes in, because when a new fund is coming out, a CVC unit, then thinking about these things really, which is where your expertise is so important, because there are a lot of ramifications for this.
Setting up a fund is critical to get it right at the beginning, right? You really want to understand what you're doing, understand your strategy as a lawyer. It might sound strange to some, but the more information we have along the ultimate goals, the better we can be at kind of helping you strategize as to what is the best potential outcome for you down the road that leads to the least confusion for your program and for your team. Because the last thing we want to do is draft a document that ultimately you look at and you say, well, that's great, and we understand that's what the legalese means, but it's not practically speaking how we want to apply our strategy and our function. So the more we can be involved in those conversations, generally speaking, the better off we feel we can be in terms of providing counsel and advice, and we believe better service to the clients.
And Tamara, have you experienced this with setting up a fund as you come in to how this is your experience with these different types of structures?
Yeah, I have been privy to help both funds kind of develop their phantom carry to make sure it fits with the strategy of the company. It is important to note it's part of the total compensation, right? So you have the benefit of a corporate fund where you are investing off the balance sheet. So you're really not raising funds, right? You're not out there trying to spend time convincing LPs to invest in you. You have one LP, your CEO, CFO, depending on who inside the company. So it is different, but yeah. And, I think it's important, as James said, to have your outside counsel involved from the beginning so that it's set up, correctly.
Yeah, you understand what the different hurdles and challenges might be if if you set it up one way versus another, because changing gets tricky, right?
Very.
Yeah.
Yeah, or potentially taking away, right? Which some companies do, which can be also not awesome. So you really have to understand the
Yeah.
caveats that you put in it to begin with.
That's when they call us, is when they started with one thing and they find out that they're not going to continue with that either. It was too successful and the CVC folks were making too much money and they can't keep going at that pace, or they're having turnover and they need to be more creative. But either way, that those are pressure points where it's obviously tricky to make sure to be successful when you've got to navigate quickly because or make an adjustment from where you started. So that's sort of why we're here today, is to discuss more of this. And James, the last one here is obviously the separate entity, right?
Yeah, separate entity with a dedicated fund, probably the most closely aligned with the traditional VC sort of arm or
Right.
fund. Uh, I always find it interesting that that number's staying that high. I personally thought that number would start to come down a little bit over time, but it is not, which is interesting. But yeah, it's the closest to a traditional VC model that you're going to see. And the ones we deal with here in this case mostly are more about financial return than strategy return, because you're setting aside sort of dollars for a particular investment.
Yeah, here's just a little more background data, like what percentage of the current team came from the parent corporation. And you can see that the less than 10 is and the more independent, the more you see the separate entity, the less people are coming from inside of the parent company. And then this is have you hired people from outside the company? This is for obvious reasons, that the more you want to echo being like a VC fund, then you want people who have experience in investing. And then what types of organizations did the new hires come from? And you can see obviously VC firms. I mean, let's face it, right now, one thing we know from VC firms on our venture side, we're co-branded with PitchBook on that survey data as well. So we get some insights from them, is that the vesting times for carried interest are now hovering typically over 10 years. And so all that glitters is not gold, right? People are not getting a carried interest return in a very fast pace, like those go-go.com days. In addition to this, just like Tamara said, is that you've got to invest capital, you've got to raise a fund, and then typically these senior people have to contribute capital for their carried interest, which is not what you usually see in a CVC fund. And then in addition to that, the IPO market and the liquidity market, as we know, we did a webinar with PitchBook on investment firm compensation, and the analysts shared that it's been slow and things are
Yeah, and
picking
I
up a
think that
little.
that's the real issue, right? I mean, that's why those hold times have become longer, because the hold times for the investments has become considerably longer than say 5, 6, 7 years ago, right? So that if the hold time is longer for to exit the investment, carry has to sort of follow that, or you frankly don't have a measurement point, or you don't have the same team that's there, from beginning to end. So
Yeah.
it's definitely related to the whole time.
Tamara, thoughts on this? Obviously, you've experienced this inside as an investor, so you're not raising capital, but even so, the liquidity's been slower to happen.
Yeah, correct. Which I think that's one of the advantages of being with a corporate fund, provided that the corporate parent is doing well. If you can kind of combine the compensation, depending on how well the company is doing and how well your fund is doing, it's a better mix, at least at the moment. Right now, it could
Yeah.
change in 5 years, but at the moment, I think it's a win-win to have a company that's doing well and your fund that's doing well.
That's exactly it. So let's look at this because you really nailed it. So what are the other incentives in addition to base pay and cash bonus? So this is by the type of entity that you have. So not off balance sheet or off balance sheet. And you can see that the not off balance sheet leans more towards the corporate stock, and that the off balance sheet has a little more independence in terms of carried interest or some shadow phantom synthetic carry, or in some cases, some kind of mix. But that's exactly right. That's the nice thing about a CVC, is that you have some stability because you're not raising the fund. You don't really have that LP relationship in any traditional way that adds more pressure. And then here is what are the other incentives in addition to base pay if you're not off balance sheet or a separate legal entity? And that's what's great about our data. At J.Thelander, we've been doing this a long time. We've been doing the CVC data now for almost 10 years, really since it became somewhat of a career track. And you can see from 21, 22 to 23 to 24 is that it's been a lot of consistency. So these are the kinds of questions as you're setting up your fund, or if you're going there for your career and you're looking at this, exactly what Tamara said, is to understand the comp levers, because it is not going to be as creative depending on the structure of the fund. And James, you mentioned this. Any other thoughts on this?
I always find it interesting for whatever it's worth, and it's just an opinion, not a legal conclusion. I always find it interesting that that second set of columns, some form of carry only, is higher than corporate stock and some form of carry. It just sort of, I think there's a thought, and I think that this thought is dwindling, that carry is not part of the CVC community, and it is, and people are starting to recognize that more and more, especially, and Tamara can speak to this more than I can, but as they want to attract different types of talent from different places, that's the language that they speak. That's how they're accustomed to being compensated in some form or fashion. So I just find that interesting.
Well, explain to us, I mean, from both of your experience, you're sort of the experts in the field here. If I was a CVC unit and I came to you and said, all right, I'm going to meet with management and I understand all the different comp levers, how would we set up? What are the questions that we need to ask if we want to have a mix of our corporate stock? We don't want to give that away. We don't want to get rid of that, but we do want to put in some form of carry, shadow phantom or synthetic carry. How is that doable?
Yeah, it's absolutely doable. I mean, when you think about it, the carry is really after you return the fund, right? So they're going to give you the money, you're going to invest the money, they're going to get the money back. So anything above that from a corporate perspective should be easy for them to develop a phantom carry, knowing that they want you to invest. At least in our case, we're investing in very early stage tech so that we can see what's out there in Horizon 3 and what's next, right? Which means it's absolutely going to be 10 years before these things exit, right? We can start to return the fund, pieces of it probably around year 7, but they're going to have to compensate if you want investors to invest early. And the idea is return the fund, but also invest in strategic things that we don't see. You kind of have to look at both. Or one, as James pointed out earlier, people will leave, right? So if you want them to stick it out that 10 years to get to the carried interest, you're going to have to make it attractive for them from a compensation perspective until they get to that point.
And that's where the corporate stock comes in, right? Because it's not only so you're actually in some respects a little, okay, you may be getting less carried interest than a traditional investment fund, but you have the stability of the corporate stock consistently all the way through.
Correct. And in theory, I know our portfolio, we acquire, from our portfolio, we announced one today. The venture fund just did the deal a year ago. So I'm not even going to be able to take that to where it would have gone, right? So if you're going to go ahead and buy from my portfolio, then you're going to have to compensate me from a different perspective, right? And that's kind of where corporate stock comes in as well.
And James, go ahead.
Yeah, I couldn't agree more with that. And obviously, Thomson is a wonderful company with lots of ability to do those types of deals. But I think in the public company setting in particular, one of the things that we have often to discuss is, one, convincing senior leadership that this carried concept applies to CVCs and not just VCs, right? Getting over that hurdle.
So how do you do that? What's the conversation you have? This is so important because
you
do this all the time, and not everybody, the things that you think are normal and you just know, I want you to go slow on this, because we know from our discussions with clients that this is the crux of where they're like, how do we have this conversation?
So I think you start with who you're trying to Tamara's point, right? Who are you trying to attract, and what type of talent are you trying to bring into the organization? And if you're trying to bring in talent externally that is not within sort of the parent company's structure to begin with, and they have, sort of VC or PE background, they're looking for that concept, right? I mean, that's how they grew up, and that's how they understand compensation to begin with. And, I think, and it seems to us that more people are looking externally. Your data certainly shows that people are looking externally for that kind of expertise. And I think part of the issue with that is, and I don't mean any, sort of ill intent to those inside large companies, but it is a different learning curve in terms of how you're thinking about investments, what type of investments you're making, what your ultimate strategy is and your goal is. And so, you have to also, I think, kind of think about that. I, certainly if I was somebody looking for a position in a CVC, I would want that longevity there, right? I'd want to be able to understand where is my path and how do I
Right.
kind of move forward. I think that the
Yeah.
last part I'll raise, and then I'll turn it over to Mara, is I think if you get over that hurdle, then sometimes we face the hurdle of, well, okay, but there's got to be a cap on the carry, right? I mean, Jim can't make me
Right.
CEO,
Yeah.
and
We'll get
so
into that. We
that's
have
a
all
different
that
threshold.
data. Yeah. We have a whole section on shadow phantom synthetic carry. I'm going to show one more slide. And also we had a question from somebody who's on the call here. It said, is there a clear connection between the size of the company, the size of the parent company, and the structure of the investment fund? So here is a component of that. Let's see if this answers the question. And James, feel free to jump in here. So what are the other incentives in addition to base pay and cash bonus by investment capital team under management, right? So this is the less than 250 or the 250 plus. So it looks a little bit like the carried interest only. It's sort of neck and neck. So it's really more by the structure of the fund versus the assets under management, which is what we find. Is that what you find too, James and Tamara?
Yes, I mean, I think it is. I think it's also interesting that sort of the number of participants in the under or and over are relatively similar. Not identical,
Right.
but relatively similar. So it shows you sort of that somewhat of that symmetry. And I think it's more about kind of what they're trying to do as an ultimate goal. But Tamara, you might have a different thought on that.
Yeah, no, I agree with you. And I also agree with your point earlier why there isn't more people that are doing both, right? That it's
Right.
not growing from that perspective, especially since it's a longer time to exit. People know that. And if you want to attract people from the outside, right? So if your goal, which I would believe most corporate venture funds, the goal is to bring in talent that is going to find technology and startups that are unique and different than what you could go do on your own, right? So it's got to be people that are looking for things that are much further out, that are early stage startups that have relationships with traditional VCs. And those people you're not going to be able to go find internally at your company, right? They're not going to be there. So I think you're going to have some sort of structure payment if you want experienced VCs to come in and try to help you with that strategy piece. Unless you're just investing in things, like you said, the few off the, few deals a year, right? And I do think it matters how active your fund is as well. Like if you're expecting a small team to do, 2-3 deals a year, very different than you're hiring a team and giving them hundreds of millions of dollars and you're expecting them to, close 15 deals a year, right? That's a lot of deals, right? You got to be, to find 15, you got to talk to, 500, probably 1,000, right? If you really think about how many you really have to talk to find the right companies for your firm. So yeah, I think it's very different depending on what you're looking to do as a CVC.
Yeah.
Yeah, we are seeing more and more of in this environment, and I don't want to make it sound like it's a demonstrable piece of what we see, but we certainly see it where there's sort of a quasi CVC, right? There's somebody that's charged with innovation, but the question then becomes, do they really have investment authority or not? And so that obviously is a much different compensation model because you could very well do no deals, but you might well achieve your
Meaning,
goals.
can they write a check?
Correct.
Listen, that's no different than inside of a venture firm, right? Check writing ability, the premium for those jobs and the compensation on the cash and the carried interest. If you have check writing ability, that compensation is typically higher than people who don't write checks, which I'm going to segue into this for a second to share my screen so that we can talk about a little bit of the comp levers for the compensation. And then we'll move into the carried interest and how that's structured. Because obviously everyone always is glad to see a little bit comp data. But the different comp levers for CVC units is typically base pay. And then we track a current bonus, which is an actual bonus paid. And then that gets you to total cash. Either total cash is a combination of base pay and a current bonus, or some folks are just being compensated with base pay. And then we track a target bonus. And I've come to really appreciate, because it came up in a question with a firm yesterday about why this is different, why the J.Thelander data is different than any other data out there. And it is because we are not a tech company. We are not plugging into payroll, and we are not getting information like from your offer letters. This is true data that's reported individually by the CVC units, and in some cases just by individuals at the CVC firms. And I know we've got going to put up the link in the chat as well, because everyone who participates gets access to a subset of the results for no charge. That's people I'm sure are on the call saying, well, why would I participate? And that's because it's a give to get model. And also, when it comes time to needing data, obviously you want reliable data. But the problem is with plugging in, and where this is elite data, is tracking those current bonuses and target bonuses and all of this. The value of corporate stock and the shadow phantom synthetic carry is really important, because if you just look at one lever of the compensation without looking at it as it relates to the rest of the compensation, you're not getting a true picture. And Tamara, you mentioned this, and it is important because you got to understand what goes into your whole package, both as you're designing this as a CVC unit, as well as for your career. So the other levers are corporate stock, sort of goes without saying what that is. And then, James, maybe you could provide a little bit more of an in-depth and just sort of definition of what shadow phantom synthetic carry that is, and how that compares and contrasts to a true carried interest.
Yeah, so if you just think about two sort of kind of components, right? A carried interest, meaning you have a dedicated, drafted, and legally binding concept of the firm returns X number of dollars, and a portion of those dollars is basically paid to generally speaking, senior leadership within that fund, and it's part of the actual thesis of the fund. It is in essence an equity interest, and I won't get into the details here because we can't get into too many legal details here. But there's obviously tax considerations that also go along with the difference between carry and synthetic.
I don't know if this helps you. I can take this down if it's going to disrupt your definition, but maybe this helps.
Well, I mean, that's the summary of it, right? I mean, that is kind of what we're talking about. But I mean, just to sort of go back to what is sort of a synthetic, and if you think about a synthetic, it's not a actual equity interest. It is a contractual right. It is the ability to receive payment in connection with other forms of compensation, and it is designed to mimic, right, or to be a shadow, or the alternative to a true carry. It's a little bit more flexible for the parent, right, because it's not baked into the documents that form the fund. It's generally speaking baked into people's compensation models and things along those lines. So you can move those numbers around a little bit. It's a more flexible way to deal with it. It's not necessarily as tax friendly to the recipient, but it's, if you think about a shadow just the way you think about any other shadow, that's exactly what we're talking about.
And when you say the tax, without getting, like you said, too much into this, but we know the true carried interest is taxed with capital gains. And is the shadow phantom synthetic carry capital gains or ordinary income?
Yeah, generally it's not. Generally, right, it's ordinary income, right? Because it is not an equity-based concept. It is a contractual-based concept.
Yeah. And Tamara, can you want to any weigh in on this at all? I'm going to open this screen back up again that talks about how the shadow phantom synthetic carry is calculated. And maybe just because you obviously have had such a in-depth experience as a practitioner, tell us a little bit what this is, how this translates.
Yeah, I mean, mostly what I've seen is the second box in, which is percentage of return from portfolio exits, right? So we don't, I haven't seen many do it, change in fair market value of portfolio only. That'd be great. But most are real exits, right? Where the dollars have transacted and come back to the company in returns. And then those are calculated into the phantom carry. So not to say that people don't deserve to be paid on the fair market value and the markups. I just haven't seen that as often.
Yeah.
Sure.
And
So
also you
I haven't
mentioned,
seen it as often either, but sometimes we see that in connection with the annual bonus concept, right? Like if you see something demonstrably increase in value, and Jody was the one who said that's the investment we could make. I've sort of seen interesting conversations around that analogy.
Yeah,
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 and you said
agreed.
this as well. Like if you're if what you had just happened, right? You absorbed a company, you purchased someone in your own portfolio. So maybe that goes more into a bonus, but it's not based on the exit.
Yeah. I mean, we do incorporate that into carry. So, but we don't get the full value, right? So most corporate carry, at least that I've seen, they will cap internal acquisitions, right?
Yeah.
So, it's not always great when your company buys your company, exactly as you said, but it can be awesome for the company. Hence why the corporate stock is important, right? Because the value comes back to you as an owner of said public company. So
This backs up
it
what you're
should
saying
work
is that is
out.
there a cap on the maximum value amount of shadow phantom synthetic carry to be paid out? And it's, more than half say yes, and how that cap is calculated. So James, maybe you want to talk through this part for us a little bit. How is that cap calculated?
So there's a couple different ways. I'm sorry, you're talking about how is the cap itself calculated?
Yeah, I mean, we
Yeah.
survey it here, but I mean, you can look from this and also obviously your personal insights as the lawyer with the expertise.
Yeah, I mean, I think so. I think the first conversation is why is there or is there not going to be a cap, right? And sort of understanding what we mean when we say a cap. And in short, what we're saying is at some point, if the CVC returns are just astronomical, and generally speaking, this is more applicable to public companies than private companies, but can a public company have a scenario where it's paying out to Jim what is considered to be a very large, return? Almost, you almost think about when you hear about certain hedge fund returns, right? How does the public react to that and the markets? And some companies, many companies, right, 50% of them will say, well, we can't have that. We have to have some mechanism where we, as the public company, are able to absorb and get the benefit of that return. And you also share in it to an extent. And then, of course, that becomes a negotiation as to what that cap is. And a lot of times, VC folks will say, well, if I return that, I should get the benefit of that. So it's an evolving kind of conversation. I'm actually a little bit surprised that it's kind of 50-50, no cap to
If,
cap. To be
right.
perfectly honest, I would have
Yeah,
thought it
here
would
we
have been a
go.
little bit more skewed to a cap than than uh,
Yeah.
than is than is the case here. But how do you
Right. Well,
calculate,
I
right?
guess it's what you're saying is that there probably should be a cap that from the company standpoint, but from the individual standpoint, that but this is where the problems start. And tomorrow, this, right? Is that if you don't think of this in the first place, and sooner or later it could catch up with you because if that person in the CVC unit you have a big win and there's no cap, and they end up possibly having compensation that is encroaching upon the top, the 16B executives, then you got a problem.
I don't know if that is a problem, right? Personally, I mean, if they're returning the fund and there's dollars there, it really what if you're getting what you wanted back, which is return the fund, and you already effectively have a cap because you've got either 15-20%, whatever the carry is, right?
Right.
So you're already capping it at that, right? Because it's a percentage like any traditional VC fund. So I mean, it would be a very extenuating circumstance. I could see it happening. And yes, if you're public, you probably have to disclose those things and that becomes painful. But it's really no harm to the company per se if you're doing that well. That's my opinion.
No, I
Love
mean,
that.
Obviously, as
had
the
this
head of a fund,
conversation,
I don't want
right?
to
I mean,
cap,
It's
but
so good.
but to your point earlier, Tamara, right, we're saying that the corporate gets the benefit of the upside. They still get the benefit of that upside. They still get to disclose
correct.
the fact that they did X, Y, and Z, and presumably their stock price is still going to increase. I think. Look, this is again just an opinion more than anything else. I think a lot of this is optics, right? You have a situation where senior leadership is saying, "No way, my responsibility is this," and there's a perception maybe the yours is smaller. I don't know that that's necessarily the case, right? And what job is harder, what have you. And so I think a lot of this is perception. I think that the amount of times it would actually come into play are less than people would sort of suggest.
Yeah, well, here's another slide. I think that could be helpful, getting a little drilling down on this, because we did have a question. I think we sort of answered it, but I want to make sure we are answering it. What's the difference between shadow, phantom, synthetic carry, and a true carry? Is it all the same, or it's just different terms? And it's definitely not all the same. So I'm going to move into this, a couple more details on the shadow phantom carry. So I think it's great we're drilling down in this and getting into some more granularity. So how is it calculated? And this is based on the assets under management. So you can see that the 200, the little bit more to bite into, that it is the percentage of return from the portfolio exits. And sometimes there can be a corporate hurdle rate. There's almost always a hurdle rate for true carry. And then how is it true to what, James, you were saying, is cash, right?
Yes.
And typically not as a long-term capital gains, but as a ordinary income. And then the vesting time for shadow phantom synthetic carry. This is a big difference from the vesting time for true carry, which is now upwards over 10 years. It's still sticking in that 3, 4, 5. James, are you seeing this with your clients when you're setting this up?
Yeah, I mean, again, I'm always fascinated by your data because you see we see a lot of people. You see a lot of people, and it's interesting to me that you're seeing that kind of concentration in the 3 to 5 years. I personally think that'll start to stretch out a little bit as sort of we see the carry stretch out as well. But 3 years and having it be the majority, to me, that's a very interesting statistic because there's a lot that's not. I mean, Tamara has spoken about it, right? There's a lot that's not going to get returned within a 3 year window. So you're really talking about how long have I been there and kind of what's my incentive going to on a go forward basis. So I find that very interesting.
You can see it's really that big peak here for the 3 years is for the smaller assets under management. Yeah. And then as you get into the larger AUM, and I'm sure we'll do some kind of year over year and check on this and publish it to see that if that 7, 8, 10 year is growing like it is for true investment firms.
Yep.
Yeah, Tamara, what are you seeing on this?
Yeah, I agree. I think it again, it goes back to what the objective of the fund is too. If your fund is set up such that you're really investing in later stage stuff, C and D or even B, the returns should come in sooner, right? And so, but then you're generally investing in later stage companies, and it's really a combination of your CVC arm and maybe what your treasury wants you to invest in, right? So if you look at my previous life, we did a lot of early stage stuff at Microsoft, but the treasury department would be the one that went and invested in, Uber or Databricks, right? Really maybe not a lot to do with strategy of Microsoft, but from a treasury perspective, they could get returns. And that wasn't part of the CVC. So, it kind of depends. I've seen CVCs also take on that role, right? Where they take on later stage investing and early stage. So the carry may come in sooner.
Yeah, and that's a really great point. And, when we survey on the private company side and on our platform, which has all these custom filters, same thing for CVC and investment firm, we really recommend that you do not look by series of financing for the portfolio companies, but total amount of financing raised. Because, we see it. We were just in the UK last week in London because a lot of money going into life science and some, big sovereign fund going into big in tech that is life science, that they call it, instead of biotech, they're calling it tech bio. And that somebody raises a Series B and it's $100 million versus, and somebody's seed round is $10 million where it used to be like $2 million. So there's no direct calibration. This information, I think, is always helpful, as well as how is your synthetic carry, your SCI bonus pool calculated. And James, maybe you want to talk through this as well, and tomorrow to get your thoughts on it, fund-based, deal-based per exit, or a combination, right? But you can see these two big ones of fund-based, and then so the return, including a corporate hurdle rate, and then or a fund-based and deal-based early exit bonus paid before the fund-based pool kicks in.
Right. So there's a fair amount to unpack there. Maybe we should just start with sort of the difference between fund-based and deal-based, right? So if we think about fund-based, we're talking about multiple investments over multiple periods of time over the life of the fund, whatever that life is, and then the carry is calculated at sort of the end of the life cycle of the fund, or at very close to it. That's traditionally the way it was done for many years. And then I don't exactly know, but I'd say maybe within the last 10 years or so, you started to see both VC funds and private equity funds move to, I should say, maybe not move towards, but have more people where they would have really just one-off type investments. They wouldn't go raise a fund per se. They would go raise for a deal, more in the PE markets than in the VC markets. But if you apply that to this sort of scenario, you'd be talking about maybe perhaps a CVC fund that has multiple investment theses, and Jody's responsible for thesis one, and there's a return of X in that cylinder, that silo, where she is paid a carry or a bonus or what have you based on the return of that either one-off investment or series of investments within a portion of the fund. And we're certainly seeing those two things being used more frequently now as funds are becoming more diverse in their portfolio models and kind of what they're thinking about in terms of their investment thesis. But Tamara probably has some thoughts on that too.
Yeah, no, I do agree with that. The idea of paying based on when deals happen and then having a clawback if the total fund isn't returned. I've not seen that. It's interesting that's part of it. I haven't seen it in the synthetic carry plans I've looked at or done. It is interesting. I have seen where they'll do vintage based, so where it's annually, like what part, like if you've got a $300 million fund and it's a 3-year fund and you're allocating 100 million per year or something like that, you can do it based on payment of that year, so that you vintage each carry pool, if you will, or carry plan. But I've not seen the deal based and the clawback. It's interesting to think about.
Yeah, here's this also is how is your synthetic carry bonus fund based, deal based, or a combination, again, by assets under management.
Yeah. The one thing I'd say about the clawback, it doesn't surprise me to hear you say that. We draft for them in many instances. I think that times that they're used anecdotally is probably very few. I mean, if you're going to claw back from somebody, you're probably not keeping that person around very long, right? And something much different has gone on, and it has obviously income consequences, tax consequences, just retention. So it doesn't surprise me. I think when we see it often used, or we don't see it often used, but when we do see it used, a lot of times it's fairly unique situations and perhaps something
else
else
to say that, like, does your shadow program incorporate a clawback provision? We ask this question, comes up, but most do not.
Yeah, I think it's very difficult. As a lawyer, it would be very difficult for me to say to a client that, wait a second, you hit a hurdle and now something can claw it back. I mean, I think, again, if we're talking about certain very unfortunate situations, that's one thing, but it's not a typically exercised clause, even when it's drafted for.
Okay.
Here's some other details on that. One, fund expenses are included in that calculation, in that shadow, in the SEI bonus pool calculation.
I think it's really interesting. Yeah. Sorry, didn't mean to interrupt you.
No, I'm just saying, I think it's great. We're really drilling down on this. I mean, we haven't really touched upon the actual comp numbers, but I think it's good because, James, everyone wants to know your expertise, and having Tamara on here is just like great because
this is more Tamara than me. I just find it fascinating when you have conversations about what constitutes an expense. How do you define an expense? What is allocated across various different arms? Wait, I used Jim this much this year and you only used them this much. I mean, there's so many different elements to this that come into play. And to be perfectly honest with you, we can only draft for what we can think about and know. And so we tend to try to use words that are somewhat broad in nature at times, because it's hard to know what constitutes an expense when you're drafting the fund documents, and then you have to look at the document 5 years later.
Yeah, no, I agree. I think it's why the phantom carry funds and synthetic carry plans that I've seen are maybe not 20%, right? They're 17, 15, right? They're just incorporating, hey, it's going to cost about this much money to run the fund, so we're going to leave out some small percentage as that. The other way
Yeah.
you can look at it is if the fund has a separate P&L altogether and you are able to track it, right? So you're allocating some dollars toward the running of that fund and they're running on a budget, then it would be easy to do. But James, you're right.
Maybe this helps. This is what you're talking about, like is it a set percentage, or I know this is sort of sprung on you, but it's very in line with what you were talking about. Is it a set percentage, related to role on team only, or is it a combination in set percentage, or exactly right? So maybe tell us what that feels like in effect.
Yeah, I mean, I think it's fair, right? In a traditional fund, you got 2 and 20, or I mean, there's a number of different ways of doing it. So what's it costing you to run your fund? And part of that too is can also be a little bit higher, because if you are giving people corporate stock and you are giving them, benefits, et cetera, it's probably slightly higher than the 2%.
Yeah.
And they don't have to raise any money, right? So they don't have the function of going out to raise those funds themselves. So that, I think that is pretty standard to have some percentage, but not an exact number, or trying to allocate like how much did Jim work, how much did Jody work. That's usually not the way. It would be really difficult to do that.
Yeah, we've seen people try to do that where they almost, have like a timesheet kind of example in there, on a daily basis. It frustrates people immensely.
Yeah.
And coming from somebody who fills out a timesheet every day and has for 25 years, I can understand the frustration. But it's difficult because you could be having multiple conversations about multiple things. Sometimes you're having a conversation about the fund's investment and the commercial side of it, and you're like, well, wait a second, how do I allocate between these two things? It just seems very difficult. And ultimately, at the end of the day, it's hard for me to imagine that the company is really benefiting from trying to get that granular, as opposed to what you're suggesting, right? Which is let's kind of look at something and holistically and make a decision.
Well, this compared to venture, where you have the 80-20 split, right? 80% of the money is coming from the LPs, 20% is coming from the GPs, the general partnership. And of that 20%, because we get very granular in this as on our surveys for what percentage of that 20% do you have for carried interest? And then further, what are you getting if you factor in carry dollars at work? So I think this really goes back to the shadow phantom or synthetic carry is very different than from a true carry. And we do see that the carried interest percentages for a corporate venture firm are still different from a true venture because of Tamara said this in the beginning, you are not raising a fund, you have one LP. And so
you can understand that. Going out and having to raise a fund, watching people do it, a lot of work. I mean, it's a lot of work.
Yeah. I'm going to show
reporting back to all of those people as well, right? So there's a lot of work involved in that as well.
Yeah. We have not, we're running out of time, which is no surprise. Maybe we're going to have to do like another version of this just on the comp data, but I'm going to show a little bit of comp data because I think that everyone on the call sort of likes that. So I'm going to look at a little bit of total cash, and I'm going to look for the CVC unit leader. So here, for example, here is a CVC unit leader, senior corporate executive, and this is total cash by AUM. And so you can see that these, the median number. So we showed you median 75th and max, because I swear to God, every time we do this, everyone's like, the numbers are so low. So that's why instead of showing you 25th, 50th, and 75th, we're showing you 50th, 75th, and max, because Tamara and James, you both know that there are people making these max numbers. They are real numbers, not outliers. There are some of those, very heavy hitting corporate venture firms who have experienced teams who are co-investing all the time. I wrote a note down tomorrow to ask this, to understand how many deals you're doing a year, but they're doing a lot of deals and they're seeing a lot of companies and they're acting more like true VCs. And that's where this does not account for if they're getting shadow, phantom, or synthetic carry or the cash value of corporate stock. This is just either a combination of base pay and bonus or base pay. But you can see that there's quite a bit of competition and it doesn't really matter by the AUM. That's sort of the takeaway here. It's hit or miss. Thoughts on this, James? You're looking at it. What do you think?
Yeah, I mean, I am a little surprised that obviously I don't know exactly how many people fit into each category, but they're absolutely real. I mean, there's no question about that. There are people making these kinds of payments, and well deserved. It's I'm a little surprised at how close they are in terms of sort of overall cash comp and the different funds. And a lot of times I think people say, and again, this isn't legal, it's more anecdotal, but if you have a fund that's 250 plus million in AUM,
Right.
you're working for a big company and they're sort of saying, here's a big pool of money. So there's something that you're not having to do. And I mean, some people would argue, well, you're so big that people are coming to you to make the investments as opposed to you finding them. And also, there's a lot of syndication going on right now. Tamara can speak to that more than me, right? But there's lots of co sort of investments going on where you just develop a nice relationship with people that are in the community and can make life a little bit easier for the senior leadership at times.
Yeah, and we're seeing on this that a smaller fund having that max number means that it is not an outlier, because outliers would be if that number were $3 million, right? We would
Yep.
drop it. But we can
Yep.
see that with the 1.2, that you can see the data is hovering 950, a million, 1.2. So this likely means that this fund, even though they right now have 100 million or less than 100 million of AUM, they're positioning themselves to be very prominent, and they're likely going to have more money coming in, more higher assets under management, and they're growing. Tamara, thoughts on this, just to wind us up?
Yeah, I actually thought it would be reverse this, by the way. I thought the larger the fund, the more you would need a senior person and to pay them
It
more
shows it
because,
for the median and 75th. See it? The
yeah,
median is
the
growing,
median
and
definitely goes up. Yeah.
yeah,
So that makes sense. No,
just
I mean, again, I think if you're attracting people that have done this before and have a good track record and a good deal sheet where they've performed and they've had returns, you're going to have to pay them if you want them to come to your firm and do the same thing.
exactly right. Talent is talent. And all I can tell you with CVCs, I'm going to wind us up. I like when we sort of roll through and say, okay, what is your takeaway from all of this, and impart wisdom to everybody on the call here. CVCs, there's not one way. We a lot of times get input from a CVC firm who tells us, here's a list of 10 CVCs, and we want you to have their survey data so that we can do a custom analysis. And all I can tell you is it's not like that. It's not the same. And Tamara, you've been out there doing this. There is not one way to look at CVC compensation. It is really better to look at in aggregate, because unlike a VC firm, which is pretty consistent by assets under management, the bigger the AUM, that the compensation goes up. There are a lot of unique ways to do this, and that's where the data is great, but our expertise and James' expertise and having top talent like Tamara, that's where you really lay it down. So keep using J.Thelander data. Please participate. Morgan's going to put the link in, and James, I'm going to turn it over to you for your takeaway.
Yeah, I guess just I always continue to enjoy these conversations and see the data, month over month, year over year. Always something that surprises me, and I think that's to your point, right? That it's not one size fits all. It's a very evolving conversation and community. It changes cycle to cycle. Obviously, we're in sort of a stranger cycle now than we were a few years ago, but I think that's part and parcel of sort of the circumstance. And for us as lawyers, going back and being able to look at the data from the last cycle that's similar to this, and kind of how are we positioning things there, what's changed, what new concepts have come into play, is really critical for us to provide solid legal advice. And then just listening to our clients, frankly, what is bothering them, what's keeping them up at night, what's not working, right? What did we draft 5 years ago that they don't need, or what do they need now that we need to be drafting for? And this kind of conversation always helps us think about how we can provide more value, not only as lawyers, but hopefully just as partners.
Yeah, Tamara, tell us. You've been
Yeah.
amazing today. We're so lucky that you joined us. Thank you.
Yeah, thank you, Jody. This has been super informative, even for me, having done this for a while. So the one thing I would say is that the difference between traditional VC and corporate is, corporations do ebb and flow, as Jim pointed out, right? You can be having, 5 amazing years and 5 maybe not so amazing years, and you've got to kind of make that CVC work, throughout and benefit, back to the company. So the compensation is going to vary at a CVC, but as long as it's fair over the period of time that they're asking you to have success, I think it's a win-win for the company and for you.
Yeah, you really got to think it out. It is not, we see this from all of it, is that it's a long game, big picture. The more you plan and set good methods and practices in place with formality and structure, and the better off that the CVC unit and you all on the call here will be in terms of your careers. With that, I'm going to wind us up. Thank you all for joining us, and we will send a follow-up, and we look forward to our next conversation.